So, if you're an investor right now, you're probably caught between two massive and totally opposite fears. The fear of missing out on what could be the biggest tech revolution of our lives, and the fear of buying in right at the peak of a historic bubble.
So, which one is it? Are we looking at a bubble that's just about to burst? Or is this the ground floor of something huge? That's the core puzzle we're going to try and solve in this explainer. And I'll tell you right now, the answer is a lot more complicated and honestly, a lot more interesting than just a simple yes or no.
All right, let's just jump right in with a number that kind of sets the whole scene here. In one single month, February of 2026, there was an estimated $700 billion in spending committed to artificial intelligence. Just let that number sink in. It's staggering. But, and here's where it gets weird, while all that cash was being promised to AI, the Nasdaq, the tech index, it actually fell 3.4% in the same month. So how does that even work? How can a sector be getting flooded with money while its stock index is tanking? That's the puzzle. Okay, so to get to the bottom of this, we've got to ask, where in the world did this $700 billion even come from? It wasn't just one big check. It was more like a tidal wave that showed up during earnings season.
One after another, the biggest names in tech stepped up and laid out these mind-blowing spending plans. We're talking Amazon dropping $200 billion, Google $185 billion, Meta $165, Microsoft $150 billion. You add all that up, that's a $700 billion bet on building out the future of AI. Now, to really wrap your head around just how insane that number is, let's compare it to some of the biggest projects in history as a piece of the whole US economy, or GDP. The entire US interstate highway system, that was about 0.6% of GDP. The Apollo program, putting a man on the moon, also 0.6%. This AI build-out, in 1 year, it's almost 2% of GDP. This is basically a national-level mobilization, but it's being driven entirely by private companies.
So the story everyone was telling was super simple. Build this stuff now, or you're going to be left in the dust forever. But during that exact same month, February, a few little cracks started to show up in that perfect story. And trust me, once you see them, you can't unsee them.
Okay, crack number one, the funding gap. Here's the thing, if you add up all the actual cash these tech giants are making, their free cash flow, it comes out to around $400 billion. But wait, we just said they're planning to spend $700 billion. See the problem? They don't actually have enough cash to pay for it all. So what's the plan? They're issuing bonds, they're taking on debt.
And that's the real kicker here. This whole AI boom, the thing that's kind of holding up the entire US economy right now, is being built on a mountain of debt. And anytime you have a growth story that depends on debt instead of actual profits, well, you're just asking for risk and a whole lot of volatility.
Crack number two showed up in the financial plumbing of the whole system. A little UK firm nobody had ever heard of called MFS, it just collapsed. But boom, Wall Street banks started plunging because turns out they'd lent these guys money. Then, in the same week, UBS puts out this report warning that the private credit market, which is like the secret fuel for this whole AI ecosystem, could see massive, double-digit defaults. Suddenly, the whole funding machine looked way, way shakier than anyone realized.
All right, and that leads us to the third and maybe the biggest crack of all. A recent study from MIT and the Boston Consulting Group asked a really simple but brutal question. After all this hype, all this spending, what percentage of these corporate AI projects are actually making money? Like a real measurable return on investment?
The answer? 5%. Yeah, just 5%. Now look, to be fair, building out infrastructure takes time, right? The spending happens now, the revenue comes later. But still, 5%, that is a shockingly low number. And this right here is what we call the monetization gap. You've got big tech spending $700 billion to build the car. But right now, the entire market for enterprise AI is only generating about $37 billion in revenue. You do the math, that's a conversion rate of, you guessed it, roughly 5%. And markets, well, they don't wait around forever for that gap to close.
So you take these three cracks, right? The dependency on debt, the shaky funding system, and this huge gap between spending and earning, and man, it paints a pretty rough picture. It really leads to one very blunt question. Is the AI party already over? When I first put all those pieces together, I honestly thought, that's it. It's a classic bubble, and it's popping. But I was wrong. It wasn't a crash. It was something else entirely. So is AI finished? The answer is no, not even close. The capital didn't just vanish into thin air. It simply moved. The story wasn't an explosion, it was a rotation. See, while all the big-name AI stocks were taking a hit, other parts of the market were just absolutely on fire. The Dow Transportation Average, a huge indicator for the real economy, was on a tear, near all-time highs. Gold surging, and copper, the metal you literally need to build data centers and power grids, almost at an all-time high. The money was just flowing out of one part of the AI story and straight into another.
And this rotation, it gives us a whole new way to look at this market. See, AI isn't just one big thing. It's really breaking apart into 3 different groups. First up, you've got the spenders. That's big tech, right? Pouring billions and billions into building the foundation, but the payoff, well, we're not sure when that's coming. Then you have the earners. These are the folks cashing the spenders' checks. Think GPU makers, power companies, networking gear. And finally, you've got the optimizers. These are the companies using AI right now to get leaner and meaner, cutting costs and showing an immediate return. Think about a company like Block Inc., using AI to streamline its operations.
And that, right there, is the single most important thing to understand. Investing in AI isn't one trade. It's like 3 totally different games happening on the same field. And they all have different rules, different risks, and different rewards. So asking, should I invest in AI? That's the wrong question. The real question is, where in this whole AI ecosystem do you want to be? Okay, so that's the big picture, but how do you actually use this? Let's take that idea and turn it into a simple framework that you can actually use to make sense of all this for yourself.
But first, you know the drill, gotta put up the disclaimer. This is all for educational purposes. It is not, I repeat, not investment advice. You've always got to do your own homework and make your own decisions.
All right, here we go. A super simple 3-step framework. Step 1, classify. Look at any AI-related company you're interested in and just ask yourself, is this a spender, an earner, or an optimizer? Put it in a bucket. Step 2, track conversion. For those spenders, you've got to watch that ratio of how much they're spending versus how much AI revenue they're bringing in. If that number gets better each quarter, things are looking good. If it stalls out, the market's going to notice. And finally, step 3, watch the rotation. What February taught us is that the most obvious AI play isn't always the smartest one. Keep an eye on those earners and optimizers, because that's where the smart money is heading. Look, that $700 billion bet is on the table, and these 3 groups are not all going to have the same outcome. So the last question I have isn't really for me to answer, it's for you. As you look out at the market, or even just at your own portfolio, which of these 3 groups are you in? Are you a spender, an earner, or an optimizer? It's something to think about.